So what is a futures contract? So back in the day when I used to run derivative investment operations and collateral management operations, I used to explain to new employees who had no idea what derivatives were. I'd hire somebody. I remember I hired this a graduate of Juilliard, right? Um, she was like an amazing violinist, and she was really intelligent. And she was like, I'm terrible at math. I don't even know why I'm applying for this job. And I'm like, you don't need to know math. You need to be professional about what you do, and responsible, and approach things with an open mind. And she had that. She had just such a level of humility about her and intelligence about her that I was like, I need her on my team. She's now a senior VP with Goldman Sachs. Um, she, she was a good hire, one of my best. Anyway, so when I get people like that, and I'd say, okay, here's what a futures contract is. Imagine, imagine you're Orville Redenbacher, okay, and you got to buy popcorn. You have to buy corn. Every fall, you're just going to go out and buy a ton of corn, right? Because you sell tons of popcorn. Um, and you have in your budget that you're going to go buy 100,000 bushels at $10 a bushel. So you're going to go pay $1 million, okay? And and what you would do is you would say, okay, well, I have this in my budget. I'm gonna go spend $1 million. Well, suppose there was a bunch of tornadoes and there was like, this just tons of devastating damage to cornfields or something because of a bad tornado season in the spring. And when you come to the fall, the price of corn is actually like $1.30, and you've got 1 million in your budget to buy corn, but you really need $1.3 million to satisfy all your contracts and the rest of your budget and stuff. So you got a $300,000 shortfall. Um, or imagine you're a farmer, and you're like, you know what? I'm going to sell 10,000 bushels of corn to Orville Redenbacher this year, and I'm going to sell it for $1 a bushel. So I'm going to get $1 million this fall when I harvest my corn. But suppose it's a bumper crop year, and all these states who usually have a difficult time growing corn, like northern states, it's just a mild summer for them. And then the states in the South where they don't, they worry about drought, they have a lot of, and all of a sudden, it's like a bumper crop year for corn, and they can only sell their corn at like 80 cents a bushel because there's just so much supply. So what ended up happening was futures contracts came into place. This is how futures contracts started. It was in the farming agricultural industry. And so what you would have happen was you had people like Orville Redenbacher, not literally, but a buyer would go to a farmer. Orville Redenbacher goes to the farmer and says, "Hey, listen, I want to buy 100,000 bushels of corn from you at $10 a bushel, and I'll pay you. I'll pay you on October 1st, and you are going to deliver the 100,000 bushels of corn to me on October 1st. Deal? Okay, good. Deal." So that's really how futures contracts came to be. Now, suppose Orville Redenbacher, it's like, one of those years where it's really a bad season, right? It's really a bad season. And the market price of corn in October is actually $1.20. He just made $200,000, right? Because really he's buying the corn for $100,000 when everybody else would have to pay $1.2 million, or a million instead, and everybody else would have to pay 1.2 million. So what he could do, suppose he had a couple of these agreements, suppose he only needed 50,000 bushels, not 100,000 bushels. He could be like, I'll go sell those other 50,000 bushels for $1.20 a piece. I'll sell those 50,000 bushels to somebody else. The contract, not the actual corn. He could just sell the contract. Like, hey, you want to buy this contract to go buy 50,000 bushels of corn from this guy? He's selling it for $1. I'll sell you this thing for like slightly less than the market price. And so he could make a profit. Likewise, farmers could do the same thing. If they were on the other side of the equation and they're like, well, I've got this contract, with Orville Redenbacher to sell him 100,000 bushels at $1, but it's been a bumper crop year, and everybody else would only pay me 80 cents, you know, he could be like, yeah, maybe I could, maybe I could sell, maybe I could find another buyer or something. So that's how futures contracts came to be. Okay. So we had futures contracts on corn and lots of other soybeans, lots of other agricultural products, commodities, gold, oil, right? And futures contracts on indices like the NASDAQ or the S&P 500 or the Dow. So that's what a futures contract is. It's an agreed upon price and an agreed upon quantity at a future date. And it's not really important to know, all the ins and outs of what a futures contract is or settlement requirements or these other things. But it is important to, I think, to just have an understanding of what an option is versus what a futures contract is. An options contract is to say, I have the option to buy something from you at a set, like a call option. I have the option to buy something from you at a set price at a future date, a certain quantity at a set price, but I have the option to do it. I'm not forced to do it. I'm not required to do it. That's a call option. If you're on the buying side. Now, if you're on the selling side of a call option, if you went short on a call option, in other words, you wrote the option, that's what it's called, writing the option. And somebody says, okay, well, I'd like to exercise the option and buy those 100 shares from you at $100. If you're on the other side of that, you have to. You don't have the option to sell it. You have to sell it. Okay. So that's what it means to go long on a call option. You have the option to buy those things. If you go long on a put option, you have the option to sell those things. Okay. So when you're buying calls and buying puts, we call that going long. Okay. When you're on the other side of it, you're going short, right? And you have the obligation to sell or the obligation to buy, right? So that's how futures contracts differ. You are actually required. Both sides are required. You're required to buy this quantity at this price, and you're required to sell this quantity at this price. Bam. Okay. Now, of course, you can buy and sell those contracts to other people, and that's what we do. We buy and sell futures contracts in the open marketplace. Okay. Hope that makes sense. That's really the big difference between a futures contract and an options contract. Okay. So how do we make money on futures? Well, you sell for more than you bought for, or you buy less than you sold for. With futures, it's easier. We buy if we think it's going to go up. We sell if we think it's going to go down. There's no calls and puts. There's just micros and minis. We'll get to micros and minis later. Okay. There's just the futures contract. Okay. So let's talk about points and ticks. Okay. I've brought up a futures contract here. This is the NQ, you can see up here, the E-mini NASDAQ 100 index futures expiring December 2024, excuse me. Okay. A point is nothing more than $1. Okay, so if we were to zoom in, okay, so you can see over here on the right, 20,400, 20,401. That's a point. It's $1. Okay. The NASDAQ is trading currently at 20,400 and change. Okay. 1 point is $1. Okay. Within each dollar, there are 4 ticks. Within each point, there are 4 ticks. Just think of ticks as quarters. 20,400 and a quarter. 20,400 and 2 quarters. 3 quarters, 20,401. And you can see over here on the right in the active trader ladder here on Thinkorswim, you can see that all the different prices that you can execute this futures contract buying and selling at are in 25-cent increments. Those are called ticks. Okay. So a tick is 25 cents. A point is $1. So here's something. We're going to go to, let's go to on demand. Well, let's see how well this works. Thinkorswim can be a real, like, on demand can be really wonky. Okay, so we'll give this a try. We'll see how this works out. There's the price. And I'm just going to pause the on demand player here in Thinkorswim while it loads the data. Up here in the upper right hand corner, it's pre-buffering it, so it's still loading data. So let it finish loading this data. And the naming convention is a little different from trading platform to trading platform or from broker to broker. But what you'll always see is a futures contract has a backslash in front of it, so you know it's a futures contract. The NQ is the underlying asset, right? In this case, it's NASDAQ, okay? And then the Z is the month that the contract is expiring. So U was September, right? And then December is Z. Okay, so there's a chart that shows like the convention, the naming convention. So that letter Z is the December expiration. Okay, and 24 is just the year. Sometimes you'll just see Z4, so you know it's 2024. Okay. So that's the naming convention. So we're trading, and the liquidity is best on the next expiration. So in September, in December, in the first week or two of December, we can still trade this, but then we'll get a notification that'll be like, hey, do you want to switch to the March 25 expiration? And I wonder what the March 25 ticker is going to be, but I think I could look it up, but it's not important right now. Okay. So anyway, that's the naming convention. You'll see that across the board. So it'll be ESZ24, CLZ24, YMZ24. Those are all the different tickers. Okay. So let's get to, let's put this thing in play because it's loaded now. Okay, so I'm going to play the on demand and we should start to see some price action here. Okay, so now you can see the price moving in the active trading ladder. Okay, let's pause it again. So what I'm looking at right now, let's say we're going to take a trade, right? We see that the price action was hitting resistance at VWAP. It broke above VWAP. Now it's retested VWAP. And so let's say now that we're like, you know what, we think it's going to bounce here. The price is going to go long. So all we have to do is buy. We don't have to enter a call. We just buy the futures contract. Okay. So there's different ways to buy, and we'll get into all that later. But what I'll do for now is I'll just put in a buy market order. Okay. So I'll hit play here. Then I'll pause it once we enter. So I'll buy, send. Okay, so we just bought one contract. Now I'm going to pause it. Okay. My quantity was one. That's why I just bought one. Okay, so we're just, and you can see here it says profit loss open is $30. Profit loss, the open profit and loss right now is $30. In NASDAQ, NQ futures for minis, this particular contract that we're talking about, one tick equals $5 of profit per contract. So since this is saying P&L open right now is $30, that means we are 6 ticks in the profit. Okay, so we entered at 399.50. 6 ticks above that is 1, 2, 3, 4, 5, 6, and that you can see that is the current market price, right? It's where the limit, the bid and the ask orders converge is at 941. So that's 6 ticks. 1, 2, 3, 4, 5, 6. Okay. I'm going to go ahead and hit play and watch this number. Okay. Watch how fast this number changes. Okay, there's 105. So let's go ahead and sell at market. See, whoops, it doesn't, I didn't have auto send checked off. I'll do it the next time I do a trade. Okay, so you can see we made $80 on that. Okay, we made $80. So if it's $5 per tick, that means we had 16 ticks of profit. 16 ticks is 4 points. 16 quarters is $4. Okay, so let's go look at the trade monitor, and you will be able to see here we entered at 39.50, we exited at 43.50. Okay, we bought at 39.50, we sold at 43.50. 4 points, 16 ticks. Each tick is worth $5. 16 times 5 is $80. Okay. On NQ, every tick is worth $5. Okay. We'll get to the other tickers in a minute. So as you can see, the price can move very fast. If you're trading NQ minis, which is what we're talking about here, let's go back to the chart. If you are trading NQ minis and you get just a very small move, you can make or lose a lot of money very fast. We do not trade NQ minis when we're just starting out. We trade micros. So let's go and look at micros, okay? So let's change this ticker now. We're gonna go to MNQ, Z. MNQ stands for micros, Z24. Let's look it up. Okay, so there it is, MNQ, Z24. Okay, same time frame here, same price action. See how the chart is exactly the same. Okay, but notice up here now how it says micro E-minis. Okay, so let's do the same thing over here. Let's back up again to 10:07. We'll just change this clock back to 10:07. We'll go back a few minutes in time here. I'll reload this. I'll pause it while it reloads. Okay, so there, we're reloaded. Okay, so now let's hit play again. Now let's go ahead and buy one micro. Okay, we got in this micro at 42.25. Okay, we'll let this thing play forward here a little bit. It's catching up, the data is catching up, so we'll give it a minute here to move us into the profits. Okay, but you can see how fast it jumps around, and during real market conditions, that's how fast the thing can jump around. So what we can do is we can put in limit orders, and I'll show you how to do this later, but we could put in like a sell limit order. Let's put in a sell limit order at like 960. Okay, we'll come way up here. Put in a limit order up here somewhere. So put in a limit order to sell. Now let's put this thing on fast forward so we can get there a little quicker. And then it should close the trade for us when it gets up here. Okay, it just closed the trade. Okay, and so now if we go back to the trade monitor and we look at that trade, okay, let's sort this by symbol. Okay, so here we are. Here's the MNQ, the micro. We entered at 42.25. We exited at 60.25. That's 18 points. Okay, 18 points times 20 times 4. That's 72 ticks. This is the one here, the micro. Okay. So we went from 42.25 to 60.25. So basically, it's 50 cents per tick instead of $5 per tick. It is 1/10 the size of the mini. The micros are 1/10 the size of the mini. Okay. So if you were to trade 10 minis, or excuse me, if you were to trade 10 micros, that is the same thing as one mini. So in options, what we used to do with options was we would start off at one contract and then we would scale up. Okay, now I'll try 2, now I'll try 5, now I'll try 10. Well, with futures, we'll do the same thing. You'll start with micros, and then if you get to a point where you've like got a nice buffer in your account, it's a good size buffer in your account, and you can start trading slightly more. You're trading 2 micros, and in a couple months you're trading 5 micros. That's what John trades. John trades 5 micros, and then maybe a few months after that you feel comfortable trading 10 micros. Well, you're not going to trade 10 micros, you're just going to trade a mini. So for me personally, I trade 2 micros, 4 micros, or 1 mini, right? So when you get to that point where you feel comfortable trading 10 micros, you're just trading 1 mini. You're not trading 10 micros. So that is NASDAQ futures. Okay. ES minis equal 1250 per tick. And we'll go look at that in a minute. And MES micros equals $1.25 per tick. Okay. All right, so let's go look at, let's go back to on demand here, and we'll look at, let's look at micros for ES. Okay. And this time we'll look for a trade where we can go short. Let's pause this. We'll look for a trade where we can just go short. Okay. All right, looks like, yeah, let's go back 1 minute. So let's go back to 1020. Let's say we have let's say we know there's like some massive price level up here, that's just been like super, we've bounced off it a million times. And let's say that we've got this, this trend line here that's like, we know that there's a channel here, something like this, right? Okay, so let's go to, what time is this? 10:19. So let me change this to 10:19 and go. And then we'll let that load up. Okay, and we are in micros, MES. And let's say we're going to trade 2 micros, okay? And so we see this trade setup coming, and we like this trade up. Let's say this 57.61 level is the prior day high. Okay, so we're going to go short up here if we wake up to that 57.61. Okay, so here's what we're going to do. We're going to put in a sell order, right? Because we want to go short. We're not going to buy a put. We're just going to go short. We're just going to sell this thing. So I'm going to put in a sell limit order at 57.60. Okay. So I'm going to come up here and I can put in my trade order ahead of time. Okay. Sell limit 57.60. Okay. And then let's go ahead and play this thing. And let's put it in. We'll put it in fast motion. So we don't have to wait around too long for the trade to develop. Let's see, where does it wick up here? Okay, there it just opened the trade for us. Okay. You can see that the the on-demand functionality is a little limited, right? The price action is not really moving over here on the right. But one thing I do want to point out though is, let's play this at regular speed. What? It's catching up right now. But when we play this at regular speed, you can see how much slower ES moves, right? It's not screaming all over the place. Yes, each tick is worth more than NQ, but the price doesn't move as quickly. Okay, so now let's say we want to close this trade. So let's just go ahead and buy at market to close the trade. Okay, we'll close the trade there. Let's go look at our trade monitor and see what we made on that trade. Okay, so we sold at 57.60.5 and we bought back at 57.54.50. Okay, so we made six, nice, easy math here, 6 points, right? So 24 ticks times $1.25 is $30 in profit. Okay, we're doing great in on demand. It's wonderful when you can just like pause things and back them up and just go trade, knowing what the price action is going to do. Isn't it wonderful? Wow, we could have held that trade pretty nicely. That would have been a great rejection. So now you can see, um, how points and ticks work and how we make money or lose money on these contracts. Okay. I think most of you have probably traded the active trader panel here in Thinkorswim. When I show you the Tradeovate setup, you will see that it's almost exactly the same as this. You're just buying and selling. You could put limit orders in, stop orders in. Okay, we'll go through all of that as well. Stuff that you all probably already know how to do, but we're going to cover it anyway. Okay, we're going to cover it anyway. So we've talked about points, and we've talked about ticks. We've talked about micros. We've talked about minis. And the tickers that are commonly traded, the ones that I trade are NQ and ES. And I'll trade both micros and minis on both of those. Okay. Other futures contracts that folks trade, CL is oil. I think YM is the Dow futures. There's a bunch out there. I don't know all of them. Okay. But the two most commonly traded ones are ES and NQ. And when people are just starting out, a lot of times they just stick with ES until they really get used to the price action with it. And then NQ, when people first start trading NQ, the people that I've coached anyway, myself personally, I liked trading NQ in the pre-market because it moved a little bit more. There's a little bit better price action on NQ than ES in the morning when things are kind of moving slow. So great job making it through this first chapter. You should now have a solid understanding of what a futures contract is and how it differs from options contracts. We also covered how we actually make money trading futures. We broke down the difference between points and ticks, so you should be able to understand how price movement works and what the potential is for making profits. We went over the key differences between micros and minis, helping you decide which is best for your trading style and where you are in your trading journey. And finally, we looked at the most commonly traded futures tickers, so you know where to focus your attention as a day trader. This foundation of what is a futures contract is really critical for success in trading futures. And in the next chapter, we're going to dive into the world of prop firms. What are they? How do they work? And how they can be a powerful tool for traders. So we'll see you there.